Hey, it's Mike here with Vant Trading again with class number 3 of 20 in our Beginners Day Traders course. We're excited about today's class. We're going to start getting into some financial education for you guys. We're going to talk about the markets, and we're going to give you, in the beginning, it'll be a little bit of maybe a refresher for some people. But it's really important because we're going to give you a good foundation of the markets and the securities that's traded in the markets. And you're going to get a good perspective in this course. You're going to get it from myself. Being a fund manager, having worked on Wall Street, I'm going to be able to give you a market maker's perspective of the markets. And then Nick's going to come into the second half of the course, and he's going to give you a little taste of some advanced stuff when he starts talking about IPO strategies, and we'll talk about a little bit about the order imbalances that you see at the beginning of the market and the end of the market. And a lot of you probably don't have been trading for a while and don't even realize why at 350, all of a sudden you see the market shoot in one direction or the other. So I think it's going to be a good course today, and maybe a little bit longer course. We're going to try to blow through some of this as quick as possible. All right, as usual, what we're going to do every day is start off with the habit of the week, and we're going to discuss a little bit. The habit this week is discipline. Okay, we talked about it yesterday. You cannot be a successful trader without discipline. It's just impossible. Okay, I saw a quote which I thought was interesting. Much of what we experience from the outside world comes from inside. So think about that a little bit. It's really your perspective and what you got going on inside. So let's talk about how to get discipline in trading. Okay. First off, it's a process, right? And when we're talking about discipline in trading, the trading plan is really going to be your anchor. It truly is. It's going to be your anchor. And by the time we're done in this course, you're going to have your trading plan. And so you're going to have a plan. You're going to trust your rules. Okay. And then the more you trust your rules, the more you're going to trust yourself. And then the more you trust yourself, the more time you're going to be able to spend focusing on how the market acts. Okay. So, through this process, you can be able to set up a nice little structure, a nice little process to be able to get you through so you can spend your time in your focus, not stressed, not trying to figure out how many shares you're going to put together or where you're getting in and out. You can spend your time focusing on market action, stock price action, okay? And then the less you care about whether you were wrong, the clearer things are going to become, and then accept gains and losses without consequence, okay? So that's what we're going to be talking about. So let's get right into it, and let's talk about the entrepreneurial process. Now, first off, again, you should have your journal. You should be making notes in your journal, and you should have a section in your journal where you're adding to your trading beliefs. So there's a couple of trading beliefs that I want to throw out there that you're going to learn today and that you should have gotten from yesterday. I already went over the ones yesterday, so I'm not going to repeat that, okay? But only price pays, okay? That's the next belief that you got to have. What you're going to learn today is only price pays. Your opinions don't matter. Keep them out. The next belief is the market is always right. Okay, the market is always right. And then the third belief is the market's main objective is to provide the most pain to the most amount of people. Okay, and then one new one you're going to get today is markets tend to eventually close the gaps. Okay, the markets tend to eventually close the gaps. So add those trading beliefs to your journal, and we're going to add them every class as we go along. So the entrepreneurial process, okay? I saw an interesting quote. The world is made up of dreamers, and I love it because that is what capitalism is all about. I love this country, and really the entrepreneurial process is the backbone. Being an entrepreneur is really the backbone of what capitalism is. So let's get into it. Really, what the entrepreneurial process is, it's you come up with an idea, you have a value, okay? You have an idea that's going to provide some tremendous amount of value, then, how can you bring that value, that idea to the marketplace? Well, you got to raise capital, right? So you go out to the marketplace, start raising capital, and then you create this business. And then next thing you know, you're producing earnings. And we talked about before, the secret, right, to really life is providing as much value as possible. The earnings is a reward for that. So when you're evaluating companies, that's one of the things you want to look at as well. What companies are providing a tremendous amount of value. And when we get into fundamental analysis and technical analysis, okay, fundamental analysis, there's a famous trader, a lot of people probably don't know him now, but Peter Lynch was big on that. Look around you, look at the companies that are providing a tremendous amount of value. They're the ones you want to invest in. And we'll get more into that as we go down the road. Okay, so there's two ways to raise capital. Okay, two ways to raise capital. One is you can sell ownership. So you can, you're creating this company, you can raise capital by giving up a piece of equity, or you can go out and borrow money, which means you're incurring debt. Well, let's look at the first piece of that part of the equation, and let's look at equity. What is it? Well, equity, we said it before, if you're selling equity, what you're doing is you're giving up ownership for capital, okay? And the key is capital typically does not have to be paid back, okay? And the way that you memorialize this relationship is that owners get what's called a stock certificate, okay? And being an owner and having equity, you get what's called a dividend, okay? And that's, you get a portion of the profits. So, and we'll get in how it's divided, how you calculate your ownership and all that stuff. So, let's say that you need to raise $1 million, okay? And you go out and you got 10 people that want to come in and they want to each give you $100,000, okay? Well, great, okay? You're giving up ownership for that $100,000 to each person. Well, it can be pretty hard to run your company when you got 10 other owners in there. Or imagine, an even bigger company like Apple or something like that, where you got, millions other owners. So how do you decide who gets a say, who doesn't? Well, what happens is all the owners get together and they elect what's called a board of directors to manage the company on behalf of the shareholders. So the board of directors are there to manage that company on behalf of the shareholders. Okay, so now let's look at the security portion of it, the stock. Okay, we said if you sell shares, okay, if you raise capital by giving up ownership, it's memorialized to the stock. Well, there's two types of stock that you can get. One is called common stock. One's called a preferred stock. Now let's look at common stock first. Okay, with a common stock, the common stock sometimes you'll hear it called the A shares. Okay, and common stock is there's several different types of shares that you got to understand. And the first level of shares that you got to understand is what's called authorized shares. Now, authorized shares is the total pool of shares that the board of directors has allowed the company to sell. Okay, so basically that is the whole pie. Okay, in a nutshell. So if let's say that you have, make it very simple, 100 shares that are authorized for you to sell, that means, if you own 10 shares, you own 10 of 100. So to calculate your percentage, you would have a 10% ownership stake into that company. Okay, now what happens is you don't have to sell all those shares right in the beginning, right? Okay, and an example I gave you was if all those shares are really, issued. Now, what issued shares are is the portion of the authorized shares that you actually go out and sell. So do you have to sell all 100 shares right at one time? The answer is no, and a lot of companies do not. Okay, now what happens is you can occasionally, let's say you sell all 100 shares and business is doing great, really great. And so you decide, you know what, man, we're giving up all this ownership. I'm going to go and take some of these profits that we have, and I'm going to go try to buy some of those shares back from the people that are owners. And I'm going to put an offer out there and go in the marketplace and try to buy them back. Well, if you do buy some of those shares back, then what happens is they now become a restricted share, okay? And they go back into the allotment, and it's considered now treasury stock. Okay, so when you hear about companies going into the marketplace buying shares back, that's what they're doing. Okay, now you also have you may have some other different types of common shares as well, and you may have what's called restricted shares. Okay, and restricted shares are really shares that have some type of restrictions attached to them. So, for example, if let's say we go and hire a bunch of employees, and you have some really good managers, and you want the employees to be able to have some ownership, for doing well, because you want them vested into your company. Well, you can do that. You want to do it through a profit sharing plan. You do it through an employee sharing plan. And so what's happening is those shares are being issued. They're common shares. And the difference is, though, they're restricted. They're typically restricted from voting, and they're typically restricted from being sold for a certain period of time. Now, you also have a situation a lot of times where you as the founder will get, a bunch of shares just for putting the idea together and being, taking the risk right up front. And so you're considered an insider. And so your shares would be considered restricted as well. Okay. So when we talk about issued shares, they are nothing more than the authorized shares that are sold, okay, and held by shareholders of the company, regardless if they're insiders, whether they're institutional investors, whether they're general public, and the key is you can find these shares in the company's annual report, okay? So, that's where you're gonna find that, okay? So, also, a lot of times when you're trading, and you're looking at a stock, you really want to know, okay, what is the float out there? Okay, what is the float? And the float is really, it's the pool that you're most concerned with as a shareholder, right? Because what you're concerned with as a shareholder is dilution. So the float that's out there is the total number of issued shares, not authorized shares, minus the restricted shares. Because again, we're kind of putting them off to the side right now. So that's what so when you hear float, that's what we're talking about. That's the pool that you're concerned about. Now, obviously what happens is, as a common shareholder, if the company decides to go out and issue more shares, we're talking about dilution here, well, you have a first right of refusal to not be diluted. So when the company offers and wants to bring more authorized shares to the marketplace, you have a right to be able to keep your percent of ownership to buy the shares that would be able to keep you that percent of ownership. Now, do you have to do that? No, but you do have that right as a common shareholder. Okay. Now, let's get into some more stuff on common stock. Okay, and we talked about, Class A shares. They're typically considered Class A shares. And sometimes you'll hear, the company's closely held. All that means is that the majority percentage of shares owned is by insiders. So they really control the company. So you may have a say in it if you buy some shares, but the insiders control all the voting and stuff like that. So that's a closely held company. Okay. Now again, remember, being an owner, if you buy a common stock, you're an owner in the company. Okay, you have a vote. You get to vote for the board of directors because you want people who are going to run the company how you want it run. Okay, so you have that say. Now you also have a right to earnings, so you get those earnings through a dividend. Okay, and the board of directors decides when and if and how much to pay that dividend. Now, as you would probably you can guess, if you're an owner, where do you fall if the company was go into bankruptcy or have to go into liquidation for some reason, well, you're at the bottom of the rung. You're at the bottom of the totem pole, so to speak. Everybody else gets paid out. If they ever have to sell all the shares and assets and everything in that company, you heard about Hertz getting, going to bankruptcy, JCPenney's, stuff like that. Well, if those companies actually follow through the liquidation process, you as a stockholder, you're not going to get anything because you're at the end of the rung. Okay. Now, what happens is the board of directors, they're going to report, okay, to the shareholders on a quarterly basis. Okay, so you're going to let me know how the state of the business is. And that's what we talk about in trading. If you're going to create yourself and you're going to be a professional trader, you need to treat yourself as if you're an entrepreneur, as if you're your own company. You should be doing your own state of affairs reporting every quarter. Okay. Now, if you're buying a stock, if you're investing in a company, you're not buying it, and it's going to sound counterintuitive, you're not buying it for the dividend. Okay. You're probably saying, you might be, why am I not buying this stock for the dividend? I thought you own a company, should you participate in the earnings? Yes, you do. But when you buy a stock, really, as the earnings get reported and they go up, what do you think is going to happen to the price of that stock in the secondary market? It's going to go up. And typically, when you see a lot of stocks, they don't pay a dividend because really investors are buying it because they want to have that appreciation in the value. Because if you don't pay the profits out, think about it like this. If you don't pay the profits out, the money stays in the business and it stays in as an asset. So what do you think happens to the value of that company? Well, it goes up, right? So if you own a piece of that company, then the piece you own goes up as well. That's what investors are more concerned about than anything else. Okay, so that's common stock. And that's what most people are looking at. If they're buying a stock, most people are buying common stock. There is another type of stock, though, that you have out there. It's called preferred stock. Okay, and actually there's a typo on there. Preferred stock is actually a lot of times considered Class B share. Okay, and again, preferred stock is the same thing, and it looks like that the slide got put on there wrong, but so I apologize about that. But anyhow, preferred stock, okay, is really, it's your Class B shares. You are a part owner of the company, okay? You are a part owner of the company, but you don't have voting rights typically. And typically what happens is you have a dividend that you're paid, and that dividend is pretty good. It's typically paid every quarter, and it's typically paid higher, okay? And you also, when it comes to liquidation, you're ahead of the common shareholders when it comes in the form of liquidation. So a lot of the deals that I did, when we were doing as a fund, remember I was telling you about, we do a lot of other deals, not just trade stock. And we were doing development deals. We would basically issue preferred shares. And the reason we did preferred shares because I wanted the investors to know that should something go wrong, should there be a liquidation, they're first in line, they're preferred. Now, a lot of people will buy preferred stock because they're looking to buy it for the dividend. They're looking to buy it for income, but it also gives you kind of the best of both worlds. It gives you the opportunity to really participate in some profits, but it's really more of an income thing. So it's a portion. It's like if you're an owner, you want to be preferred in form, you want a little less risk, preferred for a liquidation. And I'd rather get some of my earnings. I'm a little bit older. I'd rather get some of my earnings as we go. I don't want to leave my earnings in the company. I want to get them. And, but of course, again, you don't have, the voting rights and stuff like that. Okay. So that's preferred stock. All right. Now that's equity. Let's now take a look and, let's look what happens if you decide to borrow money. Right. And so if you decide to borrow money, that's what we call going into debt. Right. And, if you're going to borrow money as a company, the way it's memorialized is in the form of what's called a bond. So let's look at a bond, what a bond is. So a bond is nothing more than you borrowing money from somebody, either any entity or a person. And basically, so for each bond, there's a par value of $1,000 typically. And so I'm getting I'm borrowing $1,000, and I agree at some date in the future to pay back you all of your money, okay, the principal, at some date in the future, and that's called the maturity date. But along the way, obviously, every month, what will typically happen, or every quarter, I'll pay out what's called interest on the money I'm borrowing. So it's just like going to the bank and getting a loan and borrowing that money and paying interest every month, and then at the end, you got to pay the loan off. Okay. Now the difference is there's no ownership, right? So if you lend the company money, you don't get any ownership, but you get that income every single month or every single quarter, depending on how it is. And you do have what's called zero coupon bonds. That could be where you lend the money at a discount. You don't get any interest, but at the end of maturity, you get your full principal back. So basically, you're lending less than $1,000, but you're actually going to get that $1,000 back and get the interest back at the end at maturity. Okay. Now, why do people want to do that? One is they want income, okay? The second thing is that they want to be a little bit safer. So when it comes to liquidation, when we talk about Hertz and we talk about JCPenney, right? Who really runs the bankruptcy courts? It's the bondholders. You always hear it's the bondholders because they are first in line. Of course, the government's always first in line. You guys always knew that. But the bondholders are first in line. They're there to get their money. And that's why they're really the judge. The bankruptcy judge is really, they're talking to the bondholders and they're really allowing them to kind of guide the process through there because they're the ones. And a lot of times, they can agree to say, you know what, we'll take 10 cents on the dollar. Well, what happens is that leaves nothing for the shareholders, the common stockholders or the preferred shareholders. So that's what a bond is. Now let's take a look at this thing that we call interest. Okay, the interest that is paid, it's paid monthly typically. And the question is really, how do you know how much interest you got to pay? Well, the interest, the way to get through the interest is that it depends really on the credit worthiness of the company. So, there's a credit rating typically applied, just like you have as a person, you have a credit rating. Well, every business has a credit rating, and there's credit rating agencies out there, Moody's and Standard & Poor's. There's some of them, and they're either going to give you an investment grade rating or a junk bond rating, which is considered speculative. Now, with Moody's, if you're, I believe, negative BBB or higher, your investment grade, anything below that is considered junk. And obviously, the rates you're going to have to pay is a lot higher. Now, if you're AAA rate, you've heard that, right? AAA rate, the highest rating. Well, then obviously you're rock solid, and you're going to be able to issue bonds at the lower rate, considering where market rates are. Now, if we look at the rate, the relationship, right, to interest rates and bond prices, there's an inverse relationship. And I kind of want to explain this a little bit because, if you've been listening to some of our afternoon show, you've been watching some of our videos. I talked about yesterday how I had a nice trade about finding a trading edge. And I had a nice trade in a relationship to the TLT, to the banks and to JP Morgan. I was able to short JP Morgan based off the TLT. Well, I'm going to kind of explain that here and explain that relationship. And this is really important because one of your edges that you got to have in the marketplace, it's all about relationships, okay? You got to understand all of these relationships that are going on in the marketplace. Well, right now, bonds have an inverse relationship to interest rates because let's look at it like this one. Let's say you're borrowing money today and interest rates are, let's say, 3%. Okay, and you're AAA rated, so you pretty much can get the top rate. And so you're ready to issue some bonds today, and you issue them at 3%. Okay, now if you bought those bonds, right, and which means you gave the company money and you now own those bonds, well, what do you think is going to happen to the value of those bonds if interest rates in the marketplace after you've owned them and lent the company money? What do you think is going to happen to the value of that bond if interest rates shoot up to 6%? Well, what's going to happen is if you decided, you know what, I got graduation coming up, I'm going to see if I can sell my bonds to somebody else. Well, is somebody going to pay you $1,000 for your bond, paying 3% interest rate? The answer is no. Why? Because they can now go in the marketplace, and for other companies that are issuing bonds today, they're going to have a coupon rate, which is what the interest rate payment's called. They're going to have a coupon rate of around 6%. So why would they buy yours at 3% when they need 6%? So for you to be able to sell your bond, you're going to have to discount it to make it attractive. So you only have to sell it to them at $9.75. Now, what happens is you're saying, well, but they still get only 3%. Yeah, but they're buying it at a discount. So they're getting the rest of their money at maturity. And so the overall rate, right, the overall combined rate that they're getting is that 6%, right? So that's why it's the same thing. If you have a bond that's paying 8% and rates go down, well, geez, you may be able to sell it for $1,100. Okay, so that's where that inverse relationship comes in, and this is why you gotta really be careful. Because I love stockbrokers, right? They go out there and stockbrokers, they'll go out and try to get, oh look, it's safe. You shouldn't be in the stock market. You need to get in a bond fund. Okay. Well, let me ask you a question. Do you think as a risk-averse person you should be in a bond fund right now? Where are rates? Okay, rates are low. Okay, so if you were to buy a bond fund, okay, what do you think is going to happen to the value of that fund down the road? Well, number one is the fund's not going to really go up that much more because they can't go any lower. The Fed funds rate down to 0. Okay, so what happens when interest rates start going up? The price of that bond fund is going to go down. And back in the 80s and 90s, there was a lot of lawsuits about that because brokers were selling this stuff as a safe and secure investment for elderly investors, and they got their ass handed to them. So you got to understand these relationships, not just in trading, but also in investing as well. Educate yourself. All right, then now there's also what's called a convertible bond. That's really, again, the best of both worlds, where you have the option for a set period of time to convert your bond into common stock. So this is really, to me, almost the best of both worlds. Look, I'm going to borrow some money, right? And then I'm going to convert. I had the opportunity, the business is going great, to convert it to a common stock. Here's usually a multiplier in there to tell you how many shares you can get and stuff like that. The key is, though, think about it like this. If they're issuing regular bonds at 3% and you say, I want a convertible bond, are you going to get the same 3%? The answer is no. Why? Because you have this added benefit. So you might get 1% in interest, okay? So you're going to get a lower interest, because you have this other asset that can convert into common stock. So you're still taking some risk. You're not taking risk because if you're a bondholder, and the thing goes kaput, guess what? You can't get sued. Nobody can come after you because you're a bondholder. You don't own anything, okay? And if you don't convert, then you don't own anything anyhow. So it's your choice to convert or not convert. Okay, so that's bonds. So again, 2 ways to really, raise capital. You can sell stocks. You can, in which you're giving up ownership. You can issue bonds where you're borrowing money. And so now, hopefully, you kind of have an understanding of stocks and bonds. Now, let's go a little bit further to what we care about now, which is the markets. Where are these securities traded, right? That's what I'm talking about with the markets. Where are the securities traded? How are they traded? How are they issued? How does this all go down? Let's get into it. 2 types of markets. There's what's called the primary market and the secondary market, okay? Well, let's look at the primary market first, okay? The primary market is where you have these outstanding shares that the company has that they can sell, and they take these outstanding shares and they issue them for the very first time, right? That's the primary market. So they take these shares, they issue them, they sell them to the public. So the company receives the money that from the investors who buy those shares, okay? Now, typically, when IPO shares are out there, if there's some insiders who could be, tied up as restricted shares, but that, don't think about that later. And you can also have, actually, in an IPO market, the company reissue restricted shares, okay? Because remember, we said they go back in to sometimes the pool, okay? So that's the primary market. And the way that you issue these shares is through what's called an IPO, initial public offering. Okay, let's go through the IPO process. Okay, let's go through the IPO process. The process first is that, what happens if you're a company, you want to issue some of these outstanding shares, right? Excuse me, authorized shares. If you want to issue some of these authorized shares, and what happens is you got to go find an investment banker, right? And the investment banker, like the Goldman Sachs, JP Morgan, somebody like that. And what they're going to do is they're going to go through their due diligence, and then they're going to go and submit all the filings, SEC filings, and securities filings that need to be filed. And then, they're going to go put what's called a dog and pony show together. And why do they put a dog and pony show together? Well, they do that so that you gauge, okay, what's the interest for this company? And Nick's going to give you lots of really good examples, so I'm not going to get into that. I just want you to understand the process a little bit. They're going to go through this dog and pony show, and they're going to gauge interest, and then they're going to be able to set their pricing, right? What they're going to be able to sell these shares for, what price, based off that interest. And again, Goldman has been hired, or Morgan's been hired by you, so they have to act with your best interest at heart, okay? And then what's going to happen is, as they get closer to a date, they will finally settle on what's called a final IPO price. And typically what happens, and especially with a lot of these hot IPOs, the investment banker is basically selling them to their most private and best clients. So the chances of you getting the IPO price and getting it from Goldman or Morgan, slim to none. Okay, not happening unless Goldman really wants to stroke your back, and I don't think they're going to be doing that, right? So so typically it's sold to the private clients, and then what happens is when the IPO market gets open for trading and hits the secondary market, and that's where it's traded, and we'll begin the secondary market in a minute. Okay, so again, through this IPO process, at the IPO price, the initial price that they lock in before it comes to the marketplace, who gets that money? The company gets that money. Okay, who's paying that money? The private investors that have agreed to buy that stock. Okay, so that's the IPO process. That's the primary market. Let's now go to the secondary market. Okay, and talk about, that's really what we're concerned about as well. Though, as you'll learn from Nick, we're definitely concerned about the IPO market as well, because the IPO market, you can really have a good edge, and Nick's the best at that. Okay, so the secondary market, let's talk about that. So what happens is, let's say you bought an IPO, okay, and you lent the company money, or didn't lend it, but you gave them money, and now you got a common stock. You've invested in the company, right? So that's the primary market. The company got the money, you paid it, you got ownership. But let's say, again, 6 months down the road, company's doing great, right? And all of a sudden, oh man, I forgot, I got to pay for my child's education, I got to do this. So I'm going to see if I can sell my shares, some of my shares, to somebody else. Now, if you don't have a restricted stock, can you do that? The answer is yes. You can do it anywhere. You can sell it to your neighbor. You don't have to go to a market or anything. You can sell your shares, because when you buy your shares, you have the right to actually get a physical certificate. You have a right to actually get delivery of those shares. So you can do that, okay? But the key is, in the secondary market, what happens a lot of times, you'll go to a market exchange, just like, when you have a farmer that wants to sell some tomatoes, or wants to sell some cucumbers, right? He can sell those tomatoes or cucumbers to his neighbor and not go through anybody. But a lot of times what they'll do is they'll go drive into town, and they'll go to the marketplace, right, and sell their wares. Okay, they're selling, somebody else, right? So here in the secondary market, you have the right to sell these shares, okay, that you own, that you have a piece of, and you can sell to anybody you want. Okay, so is the company involved in that process? The answer is no, right? It's not involved. Well, how does the price get determined, Mike? Well, really, it's based upon whatever anybody's willing to pay. It's very simple, right? It's supply and demand. And now we're starting to get into the key, the psychological key of understanding the underpinning of the markets and price action, right? So really, nobody's setting that price other than what somebody's willing to pay for that price. And it's based off, what's supply and demand? Well, let's say that word gets out and everybody has heard about your company. Everybody. I mean, you're getting calls from people you've never gotten calls from. And all of a sudden, it's like, people are like, look, I'll pay you $10 to share for that. No, I'll pay you $50. Don't sell it to him. Well, what's happening there is it's your shares that you own are in demand. Okay, that's an example of your shares being in demand. So that would drive the price up, correct? Okay, another way to drive the price up is, let's say there's only, 5 shares issued, and, not many shares are issued at all. And so now, people are looking at this stock, but there's really no supply. And so, like, hey, nobody else is willing to sell. You want my shares, you're going to have to pay for them. So if they really want it, they're going to have to pay, because guess what? There's a limited supply. So both sides of the ledger there in supply and demand, it can affect price. And it works on the flip side too. And another analogy to kind of understand this is, when you have, a baseball card, and there was only 5 baseball, they made a mistake. You have Topps, they issue these baseball cards, right? And let's say they issue a set of cards, and they made a mistake, right? A really monumental mistake, and they get all the cards back that they can. But let's say there are still 10 cards issued. Okay, well, what happens is there's a small supply, and if it's really a big issue and the demand's up there, that drives that price of that stock up, right? I remember that there's a baseball card, Billy Ripken, who was the brother of Cal Ripken. He was a horrible baseball player. Nobody knew who he was. But because he wrote a cuss word, "fuck you," on the end of his bat, and they didn't catch it right away, it was issued that I had that card I could sell for $100 more than Cal's card. So, that's an example right there of supply and demand. Okay, let's get into now, let's talk about the types of markets that are out there when, if you want to go sell your shares on the secondary market. Okay, well, there's really 2 types of markets. There's what's called an exchange traded market and an over-the-counter market. Now, they have rules to these markets and stuff like that, and not any company can just, will those markets, take their wares. Just like a market in town, right? They may not allow, unless you have a table, they're not going to let you sell your wares, right? So it's the same thing in the market. So if you have some smaller companies that really don't meet this, they also have what's called the pink sheet. And a lot of times you'll find, it's the penny stocks, so to speak, the true penny stocks, not the crap they sell online, that you see Tim Sykes and everybody talking about. I'm talking about the true penny sheet, right? The pink sheet, right? The real crap of crapola. That's where, the companies just, they don't meet the requirements. So 2 types that we care about right now, because I'm not letting you trade pink sheets if it kills me, okay? So exchange traded market, let's talk about that first, okay? So when you think of an exchange traded market, what do you think of? You think of the New York Stock Exchange. It is the granddaddy of all, okay? Now, what makes an exchange traded market an exchange traded market? First off, it has a physical place of business, okay? Now, it used to be that was 100% correct. Well, now you've had such the rise in electronic trading that it's really eliminated the need to have a physical place. But, it's still, technically they do have a physical place, but, a lot of it may be done online. Now, New York Stock Exchange still, and Chicago Board of Trade, still kind of old school. New York Stock Exchange, not so much actually, believe it or not. They still have the floor that you see on CNBC with the background and stuff like that. That's New York Stock Exchange. But they really have cut down on that. A lot of floor brokers have gone and disappeared, and the specialists have gotten down dramatically. So it could be electronic, but the key is, exchange traded market, physical place of business, and it's an auction market. So what happens is you have 32 different posts, and I'm not sure how many posts they have now. They might have changed that. But you have these different posts all throughout the floor. So when you look at the floor of the exchange, you see all these different posts, and you have what's called a specialist at each post. And the specialist basically has a list of stocks that he makes a market or she makes a market in, okay? And what happens if you put an order in, right? You're going through what's called a clearing firm, okay? And the clearing firm routes that order to their broker to their trader on the floor. And that trader, well, actually what happens is they'll come off a little machine, the runner with the little blue jackets takes it and runs to the trader for that firm. And then the trader goes to that post where that stock is being sold. And it's an auction market. So literally they go there and they'll talk to the specialist and they'll say, hey, can you tell me what PG is going on the offer? Okay. And then, he'll give you a quote, maybe 25 by 25.2 at 40, right? And it means 40 lots at this, right? And so it's an auction market and you'll have other buyers there trying to buy the same stock. And, you can bid against each other. It can go up, it can go down. And that's how price is done. And that's how it was done in the beginning. And they use this really cool communication system. A lot of times they're yelling and screaming at each other. You also see hand signals. If we're live here, I can show you the hand signals that they would use, the hand signals, they go back to the runner and tell them if they bought it, then they get the little generated tape and, it's just a chaotic mess, right? And then you have the traders that are trading for their own books and they're trading for their clients' books. And, it's just a real big mess. The clearing firms are the ones that are clearing the trades. So now there's several different types of exchanges. You have the New York Stock Exchange, and you can see a little picture of it here. That's, you can see the little blue jackets and, you can see the specialists in there and stuff like that. You can see the post and all that stuff. And then you also have the NASDAQ and you have the Chicago Board of Trade. And that's where you have the options that are traded on there. And New York Stock Exchange, really neat history. Going back to 1792, it was structured. They used to have a big tree down in the peninsula of New York City where Wall Street is now. It was a really big tree with a wall by it. And that's why it's called Wall Street, because there were traders that would gather under this tree right by this wall. And that's where the exchange started, just by people coming back and forth and bartering goods back and forth in an auction type of market. So I thought that's, pretty interesting how that works, right? So, look, there's 16 global markets with over $1 trillion market cap, okay? Markets all over the place. It's international. They're all connected. It's a lot different than it used to be. Now, let's go into the over-the-counter market, which is the other market, okay? And that's really, the key is over-the-counter market. There's no physical place of business. It's electronic. You don't have specialists. You have what's called market makers. And the market makers are there to make a market in the stock that you're trying to trade with, right? And so they're the ones that are trying to provide liquidity to the market. So if you're selling, they're buying. If you're buying, they're selling, okay? And as you'll see, they make their money in the difference of the spread. Now, there's a big network now. I mean, it's pretty crazy, this network that they have now with market makers. And they have the customer network, and then you got the inter-dealer network. Because you understand that, I don't know if you've heard gamma, and you've heard about a gamma squeeze and with options and stuff like that. Well, I'll get into that in another class. But, the market makers actually taking on some risk, because the market starts really, and it's kind of like I equated it to the casinos, right? If you got a heavy betting on one side and, they pay off, well, then, the casinos, they're taking risk and they got to hedge that risk. So a lot of times if you have heavy buying, institutions coming in heavy into the buy side, well, they're short, right? Because they got to be short. And so that brings with it a certain amount of risk. And, back when I started trading, man, it was really interesting. They started to go a little bit more digital and a little more electronic, right? But it was still more exchange traded. You had the over-the-counter market. But the crash of 87 really started to change that, because they saw that when, the market gapped down, and crashed, I think it was like 23%, 25% one day. It was the largest drop in history at the time. There's problems with orders getting executed on a really fast, quick basis, right? It caused a really big problem, and the public can't get out and can't get executions. That becomes a problem, right? So you had what was called the SOs, right? System that started, and it was the first the first ECN. It was like the infancy of the ECN, but the problem is there was holes in it, right? And so you had these band of traders that got together that could really exploit the holes. It was supposed to be, the SOE system was supposed to be for small orders, right? Well, what happened was you had these guys, they're called the SOE bandits, and they were front running all of the market makers' orders because they could do it instantaneously with huge orders, only trying to grab a penny or 2 pennies, or even a half of a penny, because they were using such size. And they were able to do it because they were manipulating really a hole that was in the system. So if you ever get a chance to read the book about it, man, they were crazy. I knew a couple of them when I was up in New York, and it was high flying. So they were called the SOE fans. But really, they fixed that hole, obviously. And what happened was the market's evolved, and now you got these ECNs, and you got, we're going to talk market structure and all that later. So, you got a bunch of different ECNs. If you ever look at level 2, you see all these different companies. You got the Island, Archipelago, you got, you just got them all, right? You got ARCA. So that's what you're really looking at, is the different types of ECNs that's routing your orders. So that's the over-the-counter market. And so really what we're talking about is a little bit about quotes, right? And I said that the market makers are getting, how they get paid for making the market, taking this risk. Well, they get paid the spread. So if you notice when you look at a quote, a stock quote, well, typically if you see just one quote, that's the inside quote. That's that's the top line number, okay? But that's not the number you would get if you sold your stock, right? So what you have is what's called the bid and the ask. And the easiest way to remember this is brokers buy the bid and they sell the ask. And the easiest way to understand this, it's wholesale and retail, okay? If you're buying on the ask, what are you buying? You're buying retail, okay? You're buying it from the professionals. They're feeding that stock to you. If you're buying at the bid, if you're able to get at the bid, you're getting retail. And the difference is that spread. And if you notice here in this little box, it's called level 2 quotes. We're going to get into that order flow later. You can see a price on the ask, $51.35 for Coca-Cola, and you have a price on the bid, and you got $51.33. So there's a difference of 2 cents, and that goes to the market makers, right? Or the specialists. And if you look here, by the way, a little interesting tip. How do you know if you're in a New York Stock Exchange traded stock or an over-the-counter stock? Well, New York Stock Exchange stocks have 3 symbols or less. Typically over-the-counters can have 4 symbols. Okay. Now, if you're looking here at the bid and the ask, again, brokers buy at the bid, they sell at the ask. So, if you're buying, obviously you're going to have to buy higher. Now, can you place your order somewhere, in between? Can you place your order? Let's say you place your order at $51.34. What's going to happen to this little box? Well, guess what? Because when you look at this bid, right, okay, what's going to happen is you're going to jump in there, okay? You're going to jump in on the bid at $51.34. So what you're going to need is the ask to kind of really drop down to that level so you get hit in there. But you'll notice that the order kind of slides in there. We'll get more into market flow as we go. I don't want to go too deep in the woods. I already have gone into the woods for that, and we'll get really detailed on how to read level 2 and stuff like that. First off, let me say this about level 2 and timing sales and all that. I do use it. It doesn't give you the edge it gave you a while ago. Okay, you used to be able to see, who was sitting there, who was the axe, who was actually moving in and out, moving size. A lot harder, and a lot of times I don't think it's worth your time, but we'll get into that as we go along. Now, the last part of this section, and then I'm really going to start handing this over to Nick, let him go to his part, is, there's some other areas of the market that I call the shady areas of the market. You have Instinet, which what used to be the pre-market, and, really it's where the big institutions used to really go through and buy and sell shares. And you have dark pools. And, dark pools are, basically what's going on is it's institutions just, trading shares between each other, right? Without really those shares being dropped and the public seeing what's going on. Now there is some services you can buy. You can try to get some dark pool information, get some block information. But, again, it's kind of, I call this shady area in the market because really, from a market structure standpoint, how do you know what's going on? Because we know who needs the market. The institutions do. So, visualization from looking at the monies, it's a world market now. You can see there's exchanges all over the world. It's spread throughout. It truly is. And, the thing is, when you're really talking about this market, it is a worldwide market. So that's it for me from my section. I want to really hand it over to Nick because he's going to start now kind of look at the markets for you. He's going to break down maybe some other different types of exchange traded funds, stuff like that. And at the end, definitely stick around for the end because he's going to talk about order imbalances and he's going to talk about IPOs, which really are the meat and potatoes. And that's where, some of the stuff has been a review for you. That part is going to be, it's going to be an eye opener a little bit for you. So Nick, he's the head equities trader on our floor for our fund. And I'm going to let Nick take it away.
Alrighty, I appreciate it, Mike. I will take it on from here. Mute your mic, and I will rock and roll. So first off, I'm going to start with a little bit of a wake-up call for some of you because I might hurt your feelings, but in the market, anyone who's watching this, I hate to break it to you, but you are insignificant in the market. That's right, you are the small fish. The average retail investor is the small boy out there. We cannot move a stock. The only reason or opportunity you'll have to ever move a stock is if you are trading a very thinly traded stock. And if you're trading with enough size to move it, then you might be making a mistake. I just want to give you a little landscape there that we are an automated system out there. HFTs, high frequency traders, black boxes, gray boxes, whatever else is out there, that is the meat and potatoes of the stock market these days. It's definitely over 90% these days. I would argue it's probably, it's even higher now. It's getting insane where most of the volume out there is, some people say it's artificial, it's robots, whatever you want to say, but you just need to understand that. You also need to understand that the people that move the market long term, it's the big traders, the institutions, the banks, the big boys, and where they're accumulating their money and such. Now I want to talk about, we've talked about exchange markets and some of the exchange traded markets. Well, I want to talk about exchange traded funds, or rather ETFs. And I guarantee you, if you're going to trade for even a second, you're going to hear people talk about certain ETFs because they're some of the most widely traded things out there, some of the most widely traded instruments out there in the stock market right now. And it's the way that, well, I don't want to buy just a regular company. How do I invest in the market? How do I diversify? ETFs are one of the most popular ones out there for a lot of, retirement accounts and such. A lot of people just roll their money into certain ETFs to diversify. And basically, if you were to go into the market and pull up your stock charts and pull up an ETF, it would look exactly like a stock. The stock chart would look no different. It would trade no different. You would be looking at it and you would think it's a stock for a company. And instead of, the stock where, the stock of Apple tracks the performance more or less of Apple and it's supply and demand of the Apple, these ETFs are specifically used to track a stock index or a commodity or a bond or even a basket of assets. There's a ton of ETFs out there, and companies or banks will put them together and make them and bring them to market, and they tend to actually have a higher liquidity and lower fees than mutual funds. They tend to be more attractive and more heavily traded, and they are a fantastic tool for diversification. I mean, if you're like one of those long-term traders, if you're someone who wants to make sure you don't want to just buy all tech stocks, obviously, in your retirement account, because if tech implodes, then your entire account is way down. We should all hopefully know what diversification is by now. Talking a little bit more about these ETFs, it's important to understand that the holders of these ETFs are entitled to profits, like in mutual funds, and they're paid in dividends, just like in stocks, and if the ETF liquidates, and if, some of these ETFs, and I'll give you an example of a couple of ETFs, and I guarantee you'll probably have heard of some of these. If they go under or they liquidate, you're paid some liquidation. It's just like being a part owner in a company or a stock or something like that. Now, how, if this isn't necessarily a company where one specific company can control the supply of shares, how is this done? And look, some of this, I don't know the complete ins and outs and back ends, but I know that this is how most of this is done, is that the supply of shares are monitored through authorized participants. And what I mean is that large institutions out there, if there is an ETF, and this ETF tracks a basket of 15 different stocks. This ETF has a set ratio of, well, the stock A is worth about 15% of the value of this ETF, and stock B is worth 10%. And so these large institutions can buy that basket and redeem those shares for the appropriate units of ETFs. And it sounds a little weird and mathy, but what they're doing is they're capturing a spread. So if they notice, maybe a large institution notices, well, Apple is trading less than this basket of shares, and if we buy the basket of shares and trade it for the ETF, we'll actually get a higher value from the ETF shares, then that's why they would do that. And that's a way that they could exchange the ETF shares for that basket and so on and so forth. That's one of the ways that kind of the supply of shares is monitored. You'll also have some splits, reverse splits, things like that we'll talk about in a later class where we talk about how you can trade stuff like that. But these ETFs, it's important to know is you don't usually have to worry about these, in the sense that none's perfect. There is no safe guaranteed bet out there, but these ETFs very closely trade to the underlying fair value of the assets. Otherwise, there would be huge arbitrage opportunities. For example, if there was an ETF and the ETF only followed the basket of 2 stocks, and if one of those stocks went up, the ETF should be going up about 50% of that move. If they didn't closely track that, then you could buy those 2 shares of stocks and exchange them for shares of ETFs that are trading at an absurd value, and you would make free money. So that's why, especially with technology these days and these automated systems that would be capturing this, ETFs typically trade very closely to their value of assets. And that's why a lot of people trade them and use them for their long-term accounts or to diversify or whatever. So let's actually look at some ETFs. These are some of the most popular ETFs out there. The SPY is the big one. I mean, this I'm pretty sure by a huge margin is the most traded ETF in the world. It is the SPY. Some people call it the spiders. They'll call it all sorts of things. It's usually just referred to as the SPY. And this ETF tracks the S&P 500, the big boy. This is the big market. There's also the IWM, which a lot of people just call the small caps. That tracks the Russell 2000. The QQQs track the NASDAQ 100. That's obviously the big tech boys. Then you also have, like I said, those first 3 are examples of ETFs for exchange-traded markets or markets. You also have sector ETFs. XLF is financials. XLE is the energy. So those are examples where every stock that's within the XLE basket is an energy stock. It's an energy company, and it's predetermined by whoever created the ETF and whatever their value and ratios are. Now, those last 2 are examples of ETFs that track commodities. So USO tracks oil, and it's supposed to track the price of certain oil, and GLD is gold. So if you want to buy and invest in gold, there's a number of ways that you can do this. One of the ways is you can just buy the ETF. And it's a very noob-friendly way of doing it. It's a very easy way to just invest in certain things. And there are so many different types of ETFs. Let's talk about another kind of ETF, which is an inverse ETF. Now, this allows you to capture moves lower, if the tracked ETF or the tracked market goes down and you don't like to short, because if you don't know what shorting is, it's essentially, you sell it first and then buy it back lower. But shorting, technically has infinite risk. A stock can go up to infinity. Well, if you don't like to short, or if you're maybe a fund whose prospectus does not allow shorting, an inverse ETF is like a way that you can capture moves on the way down. So buying that inverse ETF is usually like shorting a regular ETF. Now, it is important to note, and this is, this gets into something called contango and all sorts of crazy stuff that, due to mathematical reasons, holding long an inverse ETF will not have the same return if you were short a normal ETF. So that's important to note. So there is a trade-off here in trying to avoid the risk of shorting something. You're not going to get as much of a return. Something to note. And they can be one-to-one typically. So there are inverse ETFs to the SPY and to the Qs and stuff like that. And that is, the SH is the inverse of the SPY. The SQQQ is the inverse of the Qs. The DOG, the DOG, is the inverse of the Dow Jones ETF, the DIA. Now, most these are nowhere near as traded as heavily as the normal ETFs. They are still traded. I know people that trade the SQQs pretty often, actually. And it's just a nice way that some people like to trade this. Now, there's one more type of ETF I want to talk about, and this is, where a lot of day traders like to gravitate towards, and these are leveraged ETFs. Now, these are faster paced and much more hyperactive. If you know what leverage is, you will understand what this is. These are essentially ETFs that are using derivatives on the back end to amplify the moves compared to the underlying. So, if you've got the SPY, which tracks the S&P 500, there could be a 2 times SPY levered ETF, which moves twice as much as the SPY would move for every tick in the S&P 500, up and down. So this can increase your upside, it can increase your downside. They can also be inverse leveraged ETFs. So for every tick down that the SPY makes, that inverse leveraged ETF ticks up twice as much or 3 times as much. So there's all sorts of crazy stuff out there. Obviously, the crazier you get with these ETFs, the thinner they're going to be, the more unpredictable they're going to be. It's something to keep in mind. Just as an example of some of the ones that are out there. Whoop, jumped on by. You've got the UVIXI, which is probably one of the more popular ones you'll hear. It's the short VIX future. So if you think volatility, it's understandable. SSO is the SPY leveraged. Nugget is the 3 times gold miners bullish, so you want to be long gold miners, but gold miners move really slow 90% of the time, and you want a little more action and juice. You can trade Nugget. UCO is crude oil. There's all sorts of leveraged ETFs. Like I said, they're not as heavily traded as normal ETFs, so they're thinner. They obviously have more risk, but just something that you need to keep in mind because not every ETF is the same. Let's talk about one more thing which sounds very similar to ETF but is actually pretty different, and that is the exchange-traded notes. So this is similar to ETFs. People refer to them as ETNs, except this is actually a debt note. So it's issued by a bank, and that debt note actually tracks an underlying asset, much like an ETF. So while the ETFs actually correspond with underlying shares that the fund behind the ETF actually hold, the ETN is just a note issued by a bank. And if that bank goes under, well, now the value of the ETN is at risk because you're not paid out the same. You're just holding debt in that bank. And so it's essentially kind of similar to purchasing something more like a bond than really purchasing something like a stock in this case. The underlying bank agrees to pay the holder of the ETN an amount determined by the performance of the underlying. So it's kind of this interesting hybrid thing. I don't really trade them too much or look at them too much, but it is something that a lot of people like and track. Because of that, there's fewer ETNs compared to ETFs. The liquidity is a lot lower. And the issuer is the sole supplier and controls the supply. It's not like someone else can force that issuer to give out more debt. So that's what ETNs are. I don't want to spend too much time on them. I want to get into some more of the meat and potatoes here of trading. And now we're going to talk about you want to go out there and trade, right? You want to get in there. Well, you need to understand that, first of all, the market has market hours. 9:30 a.m. Eastern, the market opens. 4 o'clock p.m. Eastern, the market closes. That doesn't mean that that's the only time you can trade. Oh, and one more thing, before I go on, I want to talk about ETFs and ETNs. Is one thing that me and Mike actually really like about ETFs and ETNs is it is a good way to play options in the S&P 500 or in the NASDAQ and stuff like that. You can actually, it's a good way to play other types of derivatives, but we'll talk about that a little later. But anyway, so the market hours of 9:30 to 4 o'clock is not the only time that you can trade. There is what's called the pre-market and after hours. And before, it was just you traded from 9:30 a.m. to 4 p.m. The trading now, you can actually start as early as 4 a.m. and you can trade. And you can go as late as 8 p.m. Now, no one is sitting there the whole time trading this because it gets very thin in these time frames, and the trading allowed in these time frames can actually vary by broker. A lot of brokers might try to protect you, rightfully so, because it's incredibly thin at 4 a.m. Who's up awake trading the stock market at 4 a.m.? You may be trading futures like some of our traders, but yeah. And obviously, the trading will get thinner and thinner away from the market hours. I would say, most of the trading volume is done between 9:30 a.m. and 4 p.m., but, and almost every day, I'm pretty sure today, and I'm pretty sure yesterday, I entered positions prior to the market opened because I wanted favorable entries. I saw some price action I liked, and I thought that maybe the stock was going to move right on the open, so I started building into a position prior to the open. And that, that's going to be something that'll be invaluable to you. Well, now some of you may be asking, well, why do we even have specific market hours? Well, obviously the traders need to know when to show up, because if there's only X amount of shares that are traded in a day, if the trading was 24/7, then volume would be incredibly thin, and you'd never have a lot of people sitting at the computer at the same time and trading. It's not like Forex that's a little more like, it's like 24/6, but Forex has multiples and multiples and multiples of the volume that the stock market does. So that's important to note. And prior to computers and electronic trading, Mike's already touched upon this with the floor, and where a lot of people used to have to actually show up to make a trade. All of trading was in person, so you needed to know when to show up. Everyone needed to be on the floor at the same time. Otherwise, at 1 a.m., some random guy might be there trying to sell his shares, and no one's there to buy from him. So, obviously, with globalization and computer trading comes more demand to trade past these market hours. I'm pretty sure the S&P didn't add, or maybe it was NYSE in general, didn't add pre-market trading until like the 90s. It was something like that, and that was when we first kind of reached, I think, like 1 million or 1 billion electronic traders at that point. But anyway, it's also easier for the market to digest news with after-hours trading. If the stock market closes at 4 p.m., everyone walks away from their desk and Apple reports earnings. Well, then suddenly, if no one can trade until 9:30, who the hell knows what people's bid and asks are going to be? How do you know, like, if Apple closed at $100 and then the next day reported earnings, maybe they were good earnings at 9:30? All right, what price you want to try to buy at? How do you know what the rest of the market is going to try to buy at? How do you know what the rest of the big boys might be interested in buying at? And having that flexibility of now there's some after hours and pre-market where you can actually see the stock go higher, and you've got an idea of where the stock is going to open at prior to 9:30, that makes it a lot more easier for people to get involved in the market on the open and prior to the close. Let's talk about trading these extended hours, because it's risky. It can be very dangerous. It's vastly less liquid, as you would obviously imagine. And also there's routing issues. You shouldn't really be using market orders anyway, but market orders and many of the routing orders don't work because a lot of those exchanges or sub-exchanges shut down. You can't use stops in many cases, not that you really should be that often anyway. But so it's very different. It's a different beast entirely. Also, your company that you might be trading is very prone to release news in the after hours. You almost never see a company report earnings from 9:30 a.m. to 4 p.m. It's always in the after hours, or it's always in the pre-market. It's no company does that, and it's just kind of how it is. And you almost always see those breaking news, the bigger breaking news, overnight. That's just how it works. You also, if you're going to eventually look to trade pre-market and trade after hours, you need to understand that you need to have a plan and you need to use less size. And as we get it more into some lessons on actually trading, we'll cover some of that and talk about that more in detail. But, that's something that's going to be important to keep in mind, because, when I build into a position prior to the open, I might not use the same sizing that I would have used if I was buying this during market hours, because it's much more thin. It's much more illiquid. Now, I do want to note, and this is an interesting stat, and I don't have the numbers in front of me, but the market itself moves a lot more overnight in general. If you had bought the SPY or the S&P 500 on the open of trading and sold it on the close of trading every day since like 1990, you'd actually be down money right now. Now, I know people always say, well, the market always goes up. The S&P, if you look at the S&P 500, it always goes up. If you buy from the open and sell from the close every day from the beginning, you are down money. And the last time I looked at this, it was before COVID, so I don't even know if that number's changed at all. But if you had bought after the close and sold right before the open, you'd be up a shitload. That's just an interesting little fact. Here's a little chart to kind of visualize what after hours looks like. This is a little exaggerated in some cases, but that shaded section right there is the after hours. And every bar here represents, I believe, 1 minute of trading. And so look at the lack of, and those bars at the bottom, in case you haven't seen a stock chart yet, represent volume. Look at the drop off in volume as soon as the market closed and it hit that shaded section. And then look at the volume spike and pick back up the next day on the open. That's just a good visual representation there of, things are a lot thinner and, there's not going to be as much action. Now let's talk about this thing that Mike had mentioned that I was going to bring up, and that's opening and closing order imbalances. So it's going to be hard to really get too fancy with this and get too adept, because, you got to understand it's a very unique thing, and if you want to really get heavily involved in it, there's a lot of news sources you might need and things like that. But it's very interesting. It's a very telling part of the market, and it can actually help formulate some of your theses and trades prior to the open. So again, I'm going to remind you, we're the small fish in the market. So how does a massive hedge fund or a massive fund out there sell and buy massive amounts of shares. They don't just market order for 500,000 shares. They'd spray themselves up and blow out their average price. So how do they get in? Yes, they can work in gradually throughout the day. They can have different algorithms, slowly accumulate shares, and many players do that. But a lot of big players will many times allocate their orders and positions on the open or on the close. And what they'll do is they'll send out a market on open or market on close order. And this is an order that they obviously have to send to the market maker or to the exchange prior to the open. And they say, I want to market buy 1 million shares of Apple on the open. That means that prior to the open, this market maker now has until the open to find a seller, find a seller for these million shares, match them up, and eventually the price in the stock is going to open. And that opening print is going to be a massive amount of shares because it's all of those orders that have been submitted prior to the open triggering at once and locking up. So you've got these massive orders that come in on the open and on the close. You actually have more, this happens more in more size on the close. The exchange has like a closing auction essentially. And this is, imbalance time. This lasts, 15 to 30 minutes of the day where, people may want to get out of their large positions on the close, so they send those orders out, and then the market maker has 15 minutes to pair off all these orders. You would think it doesn't happen that much, but there are days where there are billions and billions and billions of dollars going off on the close alone. And that is it. And so this exchange's closing auction that they have is actually designed to help curb volatility and encourage the institutions to place these large orders on the close. So, like I said, if you even just look at at a stock chart intraday, many times if you look at the volume bars, the largest volume bar in the day is going to be in the very last minute of the day. And that's because you have these very large orders that are kicking off. There are events that can cause this to get even crazier. And I'm not going to talk too much about what witching is, but there's quad witching, single witching. And what that means is that, there's multiple classes of options expiring at the same time. So people who have been accumulating options, weekly options, monthly options, quarterly options, and they expire. Now these people need to unwind out of their stock or out of whatever stock they use to kind of hedge themselves, and there's a lot of extra orders that come in, and this happens on the third Friday of every month. Just a little FYI fun tidbit there. But anyway, why do we care about these order imbalances? Why is this something that I actually spent a lot of my early professional career trading and focusing on exclusively? Well, because an exceptionally large imbalance order can actually move a stock dramatically into the open or the close. So at 345, if you have imbalance data, you can see that there is net right now 5 million shares of Alibaba to buy on the close. And you're like, depending on the stock, that might be a lot for that stock. It might be a little. If there's 5 million shares of a stock that usually only trades 100,000 shares in a day, that's a lot of volume. That market maker might not be able to find a seller to offset those shares at an appropriate price, and they might get filled really high. So the thesis here, long story short, is that people, you'll see that stock start to tick up and start to rocket up into the close, because then what people are doing is they're buying the stock and selling that stock on a market on close order, and they're capturing that same closing print that the big boy is getting. And if the big boy is, put this large buy order out, and the buy order is so big that the market maker can't find someone to sell them the shares at an appropriate price, they're going to have to get filled a lot higher. They can't cancel that order and say, all right, if you can't fill me, then fine. Now there could be they could have done a limit on close order, but that's a whole other animal. But a lot of times these large imbalance orders can move stocks, and they can even move the market. If the market has $10 billion net to sell on the close, that could be a lot, and that could end up dragging the market down a little bit as a lot of these stocks start selling off to pair off their imbalances. Something worth noting, and it's why I used to like it. Now, there are differences between NYSE and NASDAQ orders. The NASDAQ is going to open its stock at 9:30 and is going to close its stock at 4 p.m., period. That doesn't mean that you can't trade them in the after hours. That means that stock is officially open. Market orders are going to work, stops are going to work, and if it isn't, then something's wrong, and they're probably halting the stock. The imbalances with these stocks, because they're opening right away, becomes kind of this auction process of first come, first serve. NYSE, however, is a little more forgiving. they might open a stock late. In fact, over these last couple of days, I've been making a lot of trades off of stocks that are opening late. And as a novice trader, might be looking at a stock on the stock chart and might not even notice at first that this stock isn't technically open yet, because on a stock chart it looks normal. It's still trading. It's still trading past 9:30. It's just if you'll be able to tell it by looking at the volume bars, because at 9:30 you obviously see that massive spike in volume because all of these traders are now in. Those massive orders went off. But if you don't see that spike in volume, it's probably because the market maker is still panicking, trying to match these orders off. The stock isn't technically open. You couldn't market order on that. You can't use a lot of routing orders on that. A lot of algo trading and a lot of computer traders can't trade that yet. So, it's something important to note, because NYSE stocks can technically open late. An important thing to note, a lot of times at 9:28, 2 minutes before the open is when you might see some stocks move because of those opening imbalances. And that's just because that's now when you're starting to get an indication of, is this stock going to open higher or lower? How's the market maker doing on pairing these orders off? And there are some technology and some services that you can pay for. I wouldn't recommend that, obviously, until you're more experienced, that you can actually get an idea of what the current indicated opening price is. And so at 9:28, you might see suddenly Alibaba or Microsoft or something take off and start running. That's probably because of a large imbalance in one direction, and the market maker is having trouble filling that prior to the open, and so it looks like it's going to start moving the stock. Same thing in the close. You start getting an estimated closing price at 345. At 350, all the NASDAQs come out, so that can cause a whole lot of chaos. And then at 355, Mike mentioned the dark pools and how a lot of these orders are hidden. It's the same way with imbalances. A lot of people can hide their imbalance orders. However, the closer you get to the open at 355, a lot of those hidden orders become visible, and they can no longer hide those orders. So you'll see a lot of volatility the closer you get to the close. Because obviously at 345, if there's a big imbalance, the market maker has 15 minutes to fill this. He's got plenty of time. But if at 358, 359, he's still, that imbalance is still there, that market maker is having trouble filling that stock. And so, this sounds appealing. I don't recommend you start trading order imbalances, especially if you're a novice trader, especially if you're a day trader. Speed is key. I was trading these when I was in New York. I had this insane setup with insane platform and technology capabilities. I was able to get in and out with massive size very quickly. I had a lot of hotkeys. And it can get very pricey also to get a lot of the detailed imbalance information you may want. And a lot of times the imbalances can flip or pair off and you don't even realize and get hurt. So until you're a much more experienced trader, I wouldn't recommend trading them. However, you can still use these imbalance orders to your advantage. And a lot of people try to do this because what you can use these imbalance orders for is a lot of times people try to spot capital rotations, or you'll at least use it and understand why a stock might be moving into the open or close. For example, if, over the last couple days, maybe we saw a whole bunch of sell market on close orders on energy stocks. And it was a massive, massive volume that was being sold in energy stocks at the end of the day every day. Well, that might be a tell that a lot of market makers or big boys out there are liquidating their positions and getting out of energy stocks. It's actually a way that you might be able to visualize and actually see sector rotations and capital rotations within stocks, within sectors, whatever. And it's also just important to know because a large negative cumulative amount out there, if there's over up $10 billion to sell net in the market right now, that could cause the market to sell off into the close because a lot of people are clearly liquidating in the market. So let's talk a little bit, and then I'm going to let you guys go because I know we're running over here. I want to dive a little bit more into IPOs because this is something that other than imbalances, when I started trading, this was something that I started gravitating onto. And, it was something that I ended up really being good at trading, and I still like trading IPOs. I think it's really easy to trade. Well, maybe not easy, but it's really understandable on how to trade IPOs, and it's really kind of fun, honestly. But I want to talk about a little bit more is, why do they trade IPOs? Why IPO? What's the point of this company going through all of this crap where, the SEC's on their ass? They now, have to deal with all this regulation stuff. Well, look, the real reason that companies are doing this is because of money. They get a huge cash injection for IPOing. Alibaba got $25 billion on their IPO just on that initial sale. Ant, which was, originally canceled now, and I don't even know, was raising trillions of dollars oversubscribed. These companies, the larger companies at least, are making massive amounts of money on that initial cash ejection of going public. And then it's a way to further raise more capital in the future when you can offer more stock. You can now offer more things and more stock to the public and get even more capital. So, I mean, these companies can get massive amounts of capital that can jumpstart their growth, or they can do whatever they want with the money, really. It's also a nice way to increase public prestige and publicity a lot of times. A lot of companies like that. And, it's kind of an intangible thing, but that's kind of another thing that people like to talk about. Now, we've already talked about a little bit of this, but we've talked about it's important to know that the shares that you're buying in the stock market, I'm sorry to say, you're not buying when you buy a share of Apple, it's not Apple. Tim Cook's not the one selling you that stock. He might be if he's liquidating some of his shares, but no, he's not. You're buying it from other traders. Markets like the NYSE and the Nasdaq are the secondary markets, and you're getting them from the original banks, the investors, or other traders who are selling them to you, or that you're buying from, or that you're selling to. The IPO proceeds come from the primary market buyers. We're talking the big banks, the investors, and then they flip those shares to you, and then that's where those shares remain in perpetuity until a company decides to take them away or whatever. Now let's talk about the basics of trading an IPO. Get actually a little bit into the meat and potatoes just to scrape the surface here. Obviously, the IPO is available as soon as it's open on the secondary market. Kind of like imbalance orders, they can't open that IPO to trading for everyone until all of the people from the primary market who are trying to sell those shares have like a price met. Everyone who wants to sell those shares on the open for that IPO need to have a common price that they're getting on the open there. And so they're trying to match all of the buy on market orders and the people in the primary market who are trying to sell the shares into the secondary market for the first time. So as soon as that happens and they meet the price and it locks in, the stock will open, bam, the stock is IPO'd, congratulations. Now, something to note, if, when Alibaba IPO'd, I think it priced at $60 in the primary market. That means that's what all of the banks and the people in the primary market who bought those IPOs shares bought it for like $60 or something. It opened in the secondary market in the 90s. They almost never open where they priced in the primary market because obviously there's going to be a ton more demand and less supply coming into the secondary market. There's less supply because a lot of those shares are now locked up with insiders, and some of those primary buyers just aren't selling their shares right away. And then there's obviously a lot more demand because the ravenous day traders and investors and everyday person wants these shares on the market and wants to trade this IPO. Now, you may have less demand, and that's why sometimes an IPO could open up lower in the secondary market than it priced in the primary market. That absolutely happens. That happens all the time. So, it's a risk for the people buying these IPOs in the primary markets at times. But it's just important to note that if you saw that the IPO, Company X is IPOing today and it priced at $15, it's not going to open in the secondary market at $15 most likely. It might. And it happens every now and then, but it probably won't. It's also important to note the first day of trading in an IPO is very fast and very volatile. Obviously, it's because everyone's watching it. All eyes are on this stock. Alibaba did a shitload of shares and a shitload of volume on that first day of trading because everyone was watching it and people are scalping the hell out of it. There's HFTs in there, and it's chaos, but it's fun. It's great chaos. Let's talk about how you can buy the IPO. Well, obviously, you could buy the opening print prior to opening if the opening of the IPO in the secondary market, if your broker allows it. You could put on a market on order open on that IPO. You could put on a limit on order on open order. And if the IPO opens in the secondary market and it meets your criteria of price, then you'll get it on the opening print. Congratulations, you'll have it right away. Very risky if you don't know what you're doing because that stock could be down 3 points in the blink of an eye, but it's a speed thing there. And obviously, if you want to do something like that, you need to get the indications from a news source. You need to be keeping track of, well, it looks like it's going to open here. Now it looks like it's going to open here because that price is going to fluctuate the closer it gets to the open. Just something to know. Or you could just trade it after it opens. This is how I recommend most people trade IPOs. if you want to short an IPO for some reason, maybe you GoPro IPOs and it opens at $50 and you hate GoPro, you think it's dog shit for some reason, you're like, I want to short this thing. And it's going to be hard the first week or two because the amount of people willing to borrow or lend you shares is going to be lower, and so it'll also probably be more costly. Something to note. Now, why do I love trading IPOs? God, I love trading IPOs. It's because the technicals can be very clean in the first couple of days. And I'm not even talking about technical analysis like support and resistance. Whole numbers like $23 a share, $24 a share, and half numbers $23.50, $24.50. They even hold even better. And it's just you get a lot more respective technical levels because let's face it, you've got nothing else to base it off of. That you haven't gotten that much on the fundamentals of the company. They haven't reported earnings for X amount of quarters. You don't have any other technical analysis because there is no technical analysis. So a lot of times that can be a lot more intuitive, and you can see levels hold a lot more interestingly. Let's take a look at some actual charts of some actual stocks here on their IPO day, how they traded, and some of the preceding days so you can get a little visualization here. This is Alibaba on its IPO day. Like I said, I think they priced like 60 something a share in the primary market, and then this guy opened at like, what is this, 90, 93-ish a share. On the secondary market, looks like it did a little dip there. Did 50 million shares over 50 million shares in the first minute of trading, and in the first couple of minutes, that thing went from 93 to 99.70. Couldn't quite reach 100, and then it crashed all the way back down. A lot of volatility in there, a lot of opportunity to make some money in there because this thing moved. And with how much volume Alibaba does, how much chaotic trading there probably was on this day. I was actually trading it live. I actually think this was like the first big IPO I watched, so I actually have a video of it recorded on my phone because I'm stupid like that. But you can actually see it. Those dotted lines going across are whole numbers. You can see it actually held some of these whole numbers pretty well. Technical analysis actually kind of worked okay here. You could actually see the support come in there around $90 a share at the bottom. You actually see that in there because that was really all anyone had to go off of. Now look at the next couple of days. I drew a couple of lines there to make it a little easier to visualize, but there were some interesting levels there. That $90 from the first day, was resistance several days later, and you had some support come in, and you had some ways to trade off of here. Just an interesting thing to see. I want to now show you another stock, and this is another popular stock you might recognize, GoPro. I think GoPro's trading at like $3 a share now, and this one, ran on the open. It was great. But, look, that one opened and instantly went up. So if you bought on the open here, congratulations, you were up money right away and you got to play with your position a little bit. That's kind of one of the benefits to the speed there that I wanted to show you. But this one went on the open from 29 to 33. It's a small price stock, still went up, what is that, 20% or so? So, there's still a lot of momentum and movement you can get there. And you can see that $32 a share was clean resistance on it after it pulled back from 33. So you had a lot of opportunity to trade here. Now, I want to show you an example. And these charts I love these charts because GoPro, maybe you want to be a little safer. And this is exactly how you should be when you're starting out. And you don't want to trade the first day of an IPO. Well, there's going to be opportunity the following days, I guarantee you. In fact, look at GoPro the following days. It went from 29 to 33 the first day. Oh, congratulations. The next day it went from 32 to 39. And the day after that went from 38 and then went up to 42 in the after hours. These stocks, just because you don't want to trade the first day doesn't mean that there's not opportunity in these. You could have waited and been a little more patient, waited till the volume was obviously less in those next days so you didn't have to risk as much and it's not as whippy and crazy and you could have built into something and you still had opportunity. Now I want to show you my favorite stock on IPO day and more importantly the following days, and that's Beyond Meat. If anyone had been trading prior, you probably knew about this one and saw what it did. Beyond Meat, which we still trade to this day, I'm pretty sure Mike traded it today and talked about it in our afternoon show. It opened at $45 a share, went up to $72.95. That thing went up astronomically on the first day of trading alone. I mean, this thing was a monster. Now, you'd probably be thinking, well, what am I supposed to do? I'm a swing trader, or I don't want to trade the first day. It looks like I just missed the boat. Not in Beyond Meat, you didn't. That guy went from $45 to $200 in the span of a month. I mean, this thing quadrupled. It went up by a multiple of over 4, actually, in the span of a month. So, IPOs are great because they bring more opportunity into the market. And look, like 90% of the IPOs that come out there are probably dog shit companies, especially the ones with, pharmaceutical companies or whatever. These stupid companies out there that I would never touch. I don't trade every single IPO. I'd get killed because some of them are so thin. But gosh, trading big ones like this and seeing, stocks like Shake Shack open up and go to 100 and then crash back down in the following months is great, and it gives you a lot of opportunity, and it's really fun. Last slide I want to show you, because I want to wrap this one up, is so what are the things I look at in an IPO when I'm deciding, am I interested in trading this IPO? First of all is the share count. You want to know how volatile or how, liquid this stock is going to be. If this stock is coming out with 3 million shares, that's nothing. I don't want that. That's going to be so thin. I might still trade it if for some reason, if I hear something or something else I like about it, but that is really, really thin. If it's got like 50 million or 100 million, now you're talking. Now we got some volume in there and we've actually got some shares out there, and it's going to be a little more liquid. Might not move as fast, who knows, but important to note. What is the estimated volume or market cap? There's something called unicorns, which is a tech company that IPOs, and at IPOs, and upon IPO, with the price and the share count, which obviously you multiply a stock's price by its share count to get the market cap, and if it has a market cap over $1 billion on IPO, that's a unicorn. You don't see them that often. That's why they call them that. But anyway, so that's something I want to keep in mind. And because look, if this market cap is like $50 million, this is obviously some small fry company, and it's probably not going to do much because not that many people are going to be looking at this stock. So there's not going to be that many participants. So it's probably not going to go anywhere. I also want to know what the estimated price given was versus what the actual primary price decided was. They might estimate that this stock might price in the primary market at $20 a share. Turns out that the demand was bananas and they didn't plan for it, and it priced at $30 a share. That happens all the time. There are a ton of free IPO websites that actually give you this information. IPO Scoop is a great one. It'll give you all this information. There's paid ones that give you even more in-depth analysis and internals and stuff. Really cool. There's a lot of readily available stuff on IPOs, which is why I love trading them as well. But yeah, look, if they thought that this thing was going to price at $18 and it priced at $15, no one wanted it. Also, look, I'm kind of snooty in the sense that I want to know who the underwriters are. If Goldman Sachs is the lead underwriter for this IPO, that's a good sign. That means that Goldman Sachs was willing to kind of put their reputation out there, shop this company around, and underwrite for them and help them with the process. If you look at the banks that underwrote this and you don't know who the hell that is, chances are it's because the big boys didn't want to touch it. Or they didn't want to go with the big boys for some reason. Who knows? I don't know. But the underwriters can be a big deal. It's not going to be a make or break thing for me, but it's a checkbox and a little tick in the right direction for me. Also, what is the opening price in the secondary market compared to the primary? If it priced in the primary at $20 a share and it eventually opens in the secondary at $30 a share, well, that means the demand in the secondary market was huge compared to the primary market. That's a good sign. Now, that demand can exhaust itself quickly, so you got to be careful. But like I said, Alibaba, I'm pretty sure that thing priced at like $60 a share or something. I could be wrong. It could even have been lower. And it didn't open, and it opened at $93 a share. No wonder in the first couple minutes it went up to 100. It's not a surprise at all because the demand was ravenous there. So that's a little sign at how bad the demand is on the secondary market. If it opens lower, that could be a death sentence unless people see it as a cheap opportunity, but I don't want that. I don't trade stuff like that. Also, how's the market environment? This is the last point I'm going to make, and I'm going to send you all home. The market environment is really important because, for example, in late February, the market is absolutely tanking. Corona is, ravaging the country. Any stock that IPO'd there, who the hell is going to buy that stock on the open? Who the hell is going to invest in some new company into the marketplace while the market is tanking? There are absolutely dry spells for IPOs, and that is times when the market is uncertain, people aren't wanting to put money into the market, people are heavily in cash or they're withdrawing their cash. That's a big deal because that can grossly affect demand. And also, is it a hot sector? Tech would obviously be really hot. If some, stupid, I don't even know, like, construction companies can be hot as well, but if some pharma companies are a dime a dozen, or biotech companies are a dime a dozen especially, but if it's some sector or some company that's just not interesting, then there's not going to be that much demand. And that can be pretty self-explanatory, and you could see that and you could probably realize. So that's kind of my at least initial checklist when it comes to trading IPOs, and it's why I love trading them so much, because they're really intuitive and they're a good way for beginners to kind of get a sense of supply and demand in the marketplace. But that is it. I think I'm going to wrap it on up here. I appreciate everyone tuning in, and if you stuck around this long, I really appreciate it. I know we went a little longer here. These, we've got a lot of information, and they can get a little beefy out there. But we will see you all tomorrow at 7 p.m. Eastern, as always, for the next class, and safe trading, everyone.